Senior Editor of Auto Finance News, and I'm pleased to welcome you, again, some of you, to this Fundamentals of Risk Management webinar, presented by the Center for Auto Finance Excellence, the industry resource that shares best practices and actionable advice with auto finance professionals. Thank you for being a part of this webinar today. This is the first of our four-part 2015 series of webinars presented by the Center for Auto Finance Excellence through the generous support of Fiserv. This webinar, which will last about an hour and is being recorded, will explore how risk management has taken center stage as softening yields and stricter regulatory requirements force lenders to hone and streamline operations. A critical component of that restructuring is the need for a holistic approach to risk control. Competition, technology, and compliance all factor into those decisions. The substance of this teleconference harkens to just some of what we do at the Center for Auto Finance Excellence. The Center was launched in 2013 by Auto Finance News and Fiserv for the benefit of the auto finance community. The Center shares its content through events like this and at autofinanceexcellence.org, which we encourage you to join. Our goal is to share unique content and insights on the practice of auto finance, furthering the overall management performance of the industry. Fresh articles are added to the site all the time. Some of the most recent delve into how millennials want to borrow and how they want to pay, 4 tips for boosting dealer relationships, and a look at the CFPB and monetary resolutions. Today we'll discuss how lenders create a strategic plan for managing risk. What are the must-have tools? What are the steps required to develop best practices? And how do you work within current budget constraints? The information we cover today will also provide a taste of what you'll experience at the upcoming Auto Finance Risk and Compliance Summit, which will take place May 18th and 19th in San Diego. You can visit afrcs.com for more information and to register. Note that a recording of today's webinar will be available on the Center for Auto Finance Excellence website at autofinanceexcellence.org. We encourage you to share the link to the webinar with your colleagues. And with that, let's get started. It's my pleasure to introduce our speaker, Preston Cecil. Preston is the Vice President of Risk Management for Innovate Auto Finance, a role he's held since January 2013. Innovate specializes in indirect originations and third-party servicing and valuation services, including the liquidation of portfolios. The Risk Management Department is responsible for data-driven solutions for the organization, including reporting, scorecard development, forecasting, compliance, and strategy. Prior to his role in risk management, Preston worked as a senior analyst at Innovate, which he joined in 2012. Previously, he worked in equity markets, assisting in portfolio management of a large cap growth fund. Preston is going to make a short presentation followed by a Q&A session, during which you can ask him your questions. You can submit your questions by typing them into the message box at the left of your screen. You can do so throughout the presentation, and we will do our best to air them during the Q&A. So now I turn it over to Preston Cecil, who will present on fundamentals of risk management. Preston?
Good afternoon, everybody. Thank you, Phil, for the introduction. I'd also like to quickly thank the Center for Auto Finance Excellence and Fiserv, as well as Royal Media, for today's invite. Exposure for a small company as ours is very important for us and important for our growth. And I think it gives larger, more mature companies inside the minds of some smaller startups. And anytime we can share information, I think that positive outcomes occur. So my topic today, along the lines of what Phil introduced, is really simple. It's the data, the reorganization of inputs, and a feedback loop. I'll start today with a brief history of data, highlighting certain things in history, really over the last 20 years, that I think we can apply to our organization, and maybe you can as well. You know, data is really changing our models and our forecasting. It's reducing our error terms, but one of the things we may not think about as often is it's changing the workplace itself. It's changing the functions of various people within your organization that aren't necessarily involved in risk management. I'm going to follow that up was some more specific on how data is leading to the need to reorganize or restructure your inputs, being the capital, the labor, and the technology. We're seeing increased levels of automation. Of course, not everyone is as fully automated as the industry leaders, but I guarantee that we're all more automated than we were just 5 years ago, and I expect that trend to increase, if not accelerate, over the next 5 years. And it's important to remember here that data is not a job killer, but it actually creates jobs, and it increases the importance of work. And we'll talk about that as the presentation continues. And then finally, I want to hit back on what I call a machine effect, which is really these feedback loops that can lead to an upward intelligence cycle. And they can create this for an organization that continues to gain intelligence and use this intelligence to make better decisions in the future. So I'm going to start here with the brief data of history and sort of 5 key topics that I think are relevant for my firm and perhaps for yours. The first one here is going to hit on fine-tuning your algorithms. The idea that sometimes machine cannot beat a man, and a man cannot beat a man, but maybe a man and a machine can beat a superior man. In particular, I want to talk about Deep Blue. Deep Blue, again, it was an IBM artificial intelligence machine built in the 90s to compete with the best chess players in the world. After a defeat in 1996, Deep Blue returned to play Kasparov in 1997. And in 1997, overcame the loss and was actually able to beat Kasparov. So why was this the case? Why could he not win in 96 and he won in 97? Well, there's a lot of different theories, but one of the ones that seems to hold true, and I would believe is probably the mastermind, is an American grandmaster named Joel Benjamin was hired to fine-tune Deep Blue. Although Joel Benjamin himself could not beat Kasparov, and Deep Blue had failed to do so just 1 year earlier, his input, his fine-tuning of the machine, his input into the design changes and to the decision rules allowed for something increased for Deep Blue that allowed it to learn and have the ability to beat Kasparov, which is a big deal when you're thinking about your organization and the fact that we constantly need to fine-tune and increase all of our automation, all of our decisioning. The second one I want to look at here is the creation of Google. Now, Google is many things that it wasn't just 10 years ago, but when it first started, it was really the most creative search engine that there was. It wasn't the first. In fact, I think there were something like 50 to 100 search engines that came before Google. But Google managed to take over market industry. And how did they do that? Well, it's simple. Most of the text algorithms, the search algorithms, were simply just looking for the number of times a word appeared in a web page or in a website. Google was the first to change this. They were the first to explore the relationship between the website and the importance of the word to the website by looking at how many other web pages and websites linked back to that word. So this creativity, this changing of your dependent variable, if you will, really gave them a cutting edge, which would not have happened without the creativity from Sergey and Larry Page. So it's always important that we continue to foster and increase creativity within our organization. Our third example here, Moneyball, The Art of Winning an Unfair Game, written there in 2004, really showed the world that baseball and sports in general was increasing its use of data and analytics. But the important underlying theme that I felt the book had was that jobs aren't lost but rather created. At the time, the lift from data was much larger than what we see today. Today everybody uses analytics, and baseball metrics are fairly attainable and fairly predictive. But what it did was it changed the role of a scout. It put more emphasis on needing to quantify the qualitative. An example might be the temperament of a player or player interviews. And what this did was it actually increased the budgets for scouting teams across the league. And this was very important because now teams truly believed in the ability to predict player performance before they'd seen the player play on their team. And now they had an addiction to it. They wanted to see it all, and that included the scouts as much as the machines. So let's take the scouts off of the stuff that's easily quantifiable as pitch counts or batting averages are, and have them focus on the stuff that maybe a machine today can't quite quantify. The fourth one here, and this is what happens when models converge, and I actually worked in the stock market during this time, was the flash crash, if you all know what I'm referring to. In 2010, the stock market dropped by 600 points within minutes. I think it may even be less than a minute, which was very, very unusual, even given the current volatility that was in the market and some of the troubles with Europe and that stuff. So what was it? Did the numbers read wrong? Did the wrong numbers pop up? And after doing some research, what they found, and this is the theory that I still hear, is that a trader accidentally sold short a million options, actually, that he was attempting to sell short 1,000. So he sort of fat-fingered a trade. Now, these kinds of things may happen a lot. You don't normally get to play with that kind of money. This particular trader got to fat-finger a million options. Well, what's important here is to see that all of these trading algorithms run by these computers all shared very high correlations, and all of their sell signals went off at the same time. So when one computer reads sell and it's highly correlated to another computer trading algorithm, then they all sell. And this is not necessarily something we want to get to, especially in auto finance. We don't want to see us all dumping loans and then competing to find loans at the same time. You're always looking for that alpha, that piece of data that nobody else is using, whether it be an alternative data that's new to the market or something qualitative that yourself and your team is creating within the organization. And it's funny because these same trading algorithms actually reverted back to a buy signal before the day was over, and the market actually gained just about all of its losses back. And then finally, number 5, although it was happening well before 2014, I wanted to put cell phone applications in here, apps, I guess as you may call them. And what this is doing is it's increasing the quantities of data that's available. Data is a commodity just as water or oil is. But unlike oil or unlike water, there's no limited supply. In fact, it seems to be accelerating. Part of the reason for this might be the growth of cell phones. Every time I download an app, the first thing it asks me is, can I have your location? Can I have your contacts? Can I have your social media accounts? And without thinking about it, especially millennials who have grown up knowing smartphones really for a large part of their life, gladly give it up. And so this commodity, which is free and which gives us prediction and predictive powers, is really coming in quite large strides. And we have to make sure that we can take advantage of it and be able to find what's important to us and be able to swim through some of these vast oceans of data. So moving on here, I want to talk about why are we doing reorganization? Why is this the focal point of my topic? Again, our company is small. We're a startup. We're about 5 years old. So a lot of maybe the pressures that a larger, more mature company is feeling right now with needing to cut costs or hone in on operations. While some of these are always in place, they're not necessarily a pressure on us as they may be on you. What we'd like to do as a small company, and what I think a lot of small companies have the ability to do because of their size, is to really hone in on futurist ideas and be able to be a little more flexible with their strategies. Things move a little quicker in small companies, and I think it's important to take advantage of what we can before we get too big for our britches. So I want to start here with a couple lessons from history. How does data going to change how we're doing things today? How is it going to change us tomorrow? Let's just think about the Industrial Revolution. So, I have a little bit of an economics background. Historians estimate that our real output per person, for all the way from 10,000 BC, the earliest data they can find, all the way till 1300, was 0%. People basically lived and produced the exact same amount of goods and services for over 11,000 years. From 1300 AD, the growth rate did increase a little bit. They averaged 0.1 to 0.2% per year. But given that the environment we're in today, we would laugh at those and say a recession may be coming. It's basically zero. It wasn't until the Industrial Revolution that we really saw growth rates exceeding that 1% marker and climbing as high as 5% and even higher in the 20th century. So why did this happen? What was so special about the Industrial Revolution? Well, first off, we had better tools. We had the spinning jenny, the cotton gin, machine tools in general. This allowed for more output per person, given a set of population without no changes than we ever had before. So how did this work? How did this increase in better tools help us to increase our output? Well, first we had to have an adaptable workforce. So before we could massively print books, we had people thinking we had people writing the books for us. They were hand scribing them. Now those same people, maybe they're thinking about the next book they'd like to write. They're no longer worried about having to transcribe someone else's work. They're writing their own. We're not worried about threading the cotton, but instead we're focused on the conditions of the parts of the cotton gin. So we're working on the fine-tuning of these tools and how to improve them. Is there a better quality Clint leaner that I can add to the machine? Is there a faster dryer? And then finally, we had to remember the workforce was not losing jobs, but rather creating more advanced ones. We're taking a bit of the human labor out and replacing it with human capital, brain power. It's what separates us from the rest of our species. And then finally, we had technological advances which tend to increase productivity at an accelerating rate. Since technology increases lead to technology. Remember, no auto finance scorecard was ever automated without first having a computer to do so. But it's also important to note here that not all increases have to come from technological changes or inventions. They can also come from innovations. My favorite example being Henry Ford and the creation of the assembly line. When Henry Ford decided that one person working on tires and one person working on the steering wheel and one guy putting on the brakes was better than a set of people working a car from beginning to end, he realized he was getting more output per hour, and his quality was increasing. The flaw rates were reduced, and we call this specialization in economics. So this brings us to the next point. Did they take our jobs? Will the data take our jobs? And the answer is no, they didn't. They changed it. They made it better, and they increased your productivity. Come back to the professional sporting scouts from Moneyball. Again, they weren't looking at batting averages or pitch counts or stolen bases, but they were focused on the qualitative and attempting to make the qualitative and feed it back to the analyst, feed it back to the machine, and see if the analyst can structure it and create quantitative data from it, maybe through questionnaires, and feed that back to the scouts to give back to the players, and repeat cycle, constantly looking for the new qualitative data that helps give lift to the predictability of a player's performance. And my favorite example here, Mad Men. Apart from being a great show, it's also a great lesson in advertising and how maybe it should be done. Maybe what we were doing 50 years ago or 60 years ago is how we should be doing it today. You know, Don Draper, apart from Women and Booze, was only solely focused on the creativity of his ads and not the placement or maybe the demographics he was going after. And I think a lot of that stuff, the demographics, the placements, the billboards, whether it's a newspaper or an ad on TV, a lot of that stuff can be driven by the quantitative. Take your intelligent people, the ones with creative intelligence, and hone them in on what you can't currently quantify, which is the creativity portion of the marketing. My favorite being the Allstate Mayhem commercials. I'm sure you've seen those. They make me laugh, and I remember the company. So that's what we need to hone in on. That's what we need to have our folks focusing on. And finally, no more hippo. I got this from Eric Siegel, who talked about this in a book called Predictive Analytics. HIPPO stands for highest paid person's opinion. And one of the things I find that some companies, even our own at times, can get caught doing is producing output without necessarily analyzing the conclusions of it, or looking at the policies and procedures that were put in place thereof and how they're performing. I built a scorecard, I give it to my boss. I'm done, right? I build a report, and now it's on the company intranet. I'm done, right? Well, no, you need to focus on the report and look at the numbers that are coming through. And that'll allow you to focus on your current strategies and tactics as a result, and find the holes and how to fill them. So I think these are some things that we need to encourage within our individuals is, always have an opinion. Make sure you bring all supporting materials necessary to defend it, but let's always be challenging, testing, and competing. And then finally here, you've got to stay up to date on your technology. That's a given. I understand that 300-400 years ago, probably the first 10 years of our life was our father teaching us how to hunt. But we no longer have to do that. We may choose to do that, but we don't have to because we've invented, we've progressed. We now have farming. We have marketplaces and grocery stores. I'm still pondered why we use calculators, why we don't use calculators in school. Why do we still use hand math? I think maybe in putting calculators in a child's hands earlier will help them develop to the next set of math quicker, but that's a little off topic, so I'll get back to auto finance here. So moving to the next slide here, we really want to talk about the depths of our data. So we always want more and more data, and we always want different data than we have. We're trying to predict and get smarter and reduce our errors. Maybe your data is a pond. I know that when I first started, our data was certainly a pond. We didn't have very many providers. We were capturing all the data, but maybe we weren't asking the right questions to capture. In a pond, you may find 2 to 3 different species of fish. Let's make it into a lake or even an ocean where you get hundreds of species, thousands of species. Now, there's a couple ways of doing this, and some are a little more cost-effective than others, but I want to hone in on 2 of them here. The first one is third-party providers. And I think it's important when we talk about third-party providers that we talk about the 3 C's. I call them the 3 C's. And that's the cost, the coverage, and the correlation. So the cost it's relatively straightforward, and it can be company-specific or even tier-specific if you're in prime, super prime, or if you're in subprime or deep subprime. And that's that the marginal benefit you get from your data has to be greater than the marginal cost. I can hire a private investigator to follow every customer I have, assuming I don't break any compliance regulations. But the cost of having this guy follow him all the time is probably not greater than the benefit that I may prevent a 2% additional loss rate per year. It's just not, it doesn't make sense. So cost is something that's always should be on your mind. And you want to make sure you exhaust it. Continue to invest in data until the marginal benefit is exactly equal to the marginal cost associated with that data. And that's where you maximize your intelligence there. And then number 2 here, coverage. If it's useful but it's not practical, it's not implementable. I have a best friend. I've known him for years. We grew up. We went to elementary school. We hang out sometimes twice a week. And like me and you, he may want a loan for an automobile one day. And I know my best friend. I know his job situation. I know how much money he tends to have, and all these good things. And I can probably tell pretty good that he's going to pay me back if I loan him money for an automobile loan. But unfortunately, my coverage is limited to this one friend. Even my wife, who says everyone's her best friend, has low coverage. She can only cover, her 1,000 closest Facebook friends. But in reality, what we need to know is, if it's cost effective, what's the coverage rate? If you only have a 5% coverage rate and the lift just isn't there for those 5%, then we're going to have to move on. So make sure your data providers are having an increase in coverage where they can. And then finally, correlation. And this really talks to two pieces of correlation. The first one, rather obvious. You want to make sure that the data is correlated with what you're trying to predict, positive, negative, any different distributions it may take on. But you want to make sure that when you're trying to predict something, that what you're using is in fact predictable. But at the same time, you want to make sure you're not too highly correlated with any data you're already paying for. If you're buying one piece of data and it's got a tremendous lift and someone presents you with a second piece of data which also has a tremendous lift, but they're 99% correlated, you don't need both pieces of data. It's not cost effective. You're just reproducing something you already have. So it's important to look at that stuff when you look for things to add to your models. I don't want 5 great point guards for my Dallas Mavericks. I want one and maybe 1 or 2 backups. I'd also like a, power forward and a center and all those other positions. So where's the other place we can get data? Well, how about internal data producers, people mining data? And this is where really the PowerPoint's going to go from here. Your internal staff itself can create data. Some of the common methods maybe used now would be customer questionnaires. What is the best time to call you? And then our machine captures the data, structures it, analyzes it, and processes it. And you can create, policies and strategy and tactics off of this newfound data and encourage your employees to find new ones. Operational groups are someone who usually doesn't have a support role, which we'll see in a little bit. But I think as data becomes more and more important and the tools that our folks are working with change, we'll see that they in fact can become their own support groups through something we call the feedback loop. So overall support, we need to look at the qualitative and try to make it into the quantitative. We can draw these relationships mathematically. It's going to require a high level of creativity, which means developing markers if necessary. And it's an ever-changing process. Once we've defined the quantitative and we can monitor it, it's important we continue to seek new data. We're never satisfied. Again, we're always looking for that competitive edge. So if you just think about the general key inputs to your organization, you've got your capital, your labor, and your technology. Your capital, of course, being the tools you work with every day, and even the data. The data is, in fact, it's a tool. It's capital. You've also got your labor. That's your skilled workforce, either through education and or experience. You want to make sure you have creativity. This is absolutely necessary for growth. Remember, it all begins with a hypothesis. And then finally, diversity. Again, you don't want 5 Chris Pauls in your starting lineup. You want to make sure you have different types of individuals from varying backgrounds contributing to the cause. And then, of course, you always want to stay up to date on the latest in machine advancement for your technology. Remember, research and development is the key to top-line growth, which is how a firm survives over the long term. So let's take a look real quick at sort of a vanilla company structure here. Now what you see, I've sort of just set up 3 loan phases. This doesn't necessarily represent every structure of a company, but just the ones that maybe I felt were vanilla enough for this presentation. So you just break it up into 3 phases. You've got acquisitions, servicing, and finally you got asset remarketing if necessary. In gray there, you've got the operational groups that fall within each of these 3 tiers. You've got sales and marketing and underwriting and originations. For servicing, you've got your customer service, you've got your collections and any loss mitigation teams. And then finally, in our asset remarketing, you've got the teams that manage collateral liquidation, whether it be at auction or through some other means. And then sort of supporting all these operational groups is a set of the other divisions within your company. Risk management being one, IT, accounting and finance, legal and compliance, maybe quality assurance, and a handful of others which I haven't maybe showed here. What I want to do is I want to show you guys how these operational groups can actually become their own support groups through seeking and mining for data. So let's start with sales and marketing here. Just as we talked about, job functions changing in the Industrial Revolution, we know that, more recently we've had a technological boom here in the front end. The current role of the business individual, of the salesman or the marketer or the DRM, is to make the company's presence known. First, make sure people know who you are. Allow them to want to do business with you. And they need to identify and target entities that fit your profile. If it's a subprime dealer and your company's profiling super prime customers, it's the job of the sales and marketing teams to target those particular dealers that are more super prime. The second part to his current role, again, is relationship management. Of course, there's people that can talk about this much better than me, but taking a high-level view, just looking at, the relationships, either creating new dealer relationships, fostering existing relationships, maintaining comfort levels with the dealer, and also ending the poor ones and giving the dealers feedback and why it is that we can no longer do business with them and what they maybe can do to gain some of our business in the future. And then finally, some of the things that we're trying to do here at Innovate is a set of commercial level underwriting. What are the dealers' wants and what are the dealers' needs? Understanding their liquidity position and their solvency positions, any high-level metrics, visiting the dealerships, what's their average traffic, what are their sales numbers or conversion rates, how many salesmen do they have on the floor, where's the placement of the company, is it rural, is it urban, is it highway, is it side streets, does the dealer have affiliations with other entities, is it an independent or is it a franchise? And then finally, he's got to do the marketing. That's the branding of the company and really getting our message out there, defining our company's mission statement, or in the case of direct-to-consumer, creative ad placements. So let's talk a little bit here about how data is changing that role, how maybe salesmen have already began to change or have changed and will continue to change in the future. As we've seen integration systems become more and more mainstream, popular ones, Route 1, DealerTrack, ODE, even proprietary systems, we find that relationship management, while you would think is less important, always go with the highest bidder, is actually becoming more important. And we really want to turn the focus of the salesman to the macro qualitative aspects of the relationships. If we model a certain acquisition score from one dealer on one individual or a set of individuals, and that same acquisition score on another dealer, and they perform differently, there's some unexplained alpha or negative alpha to do with that dealer. We want to understand, why is the dealer performing above average? Why is it below average? The data we currently have doesn't seem to be able to predict it. So turning the qualitative into the quantitative, you can have your sales team do things like dealer grading. And some of this stuff will be specific to the salesman himself, but we know we can quantify those things. Jim giving a dealer a 4 out of 10 and Bob giving a dealer an 8 out of 10 are really the same thing. So you can have them at salesman specific. And you want to gain the insight to the dealer's reputation in the community and see if you can quantify these things. And it creates this feedback loop. And you know, some of the ways we do this on the analytics side, we can do some commercial scoring, maybe segmentation analysis, you know, really defining the risk reward of the counterparty. So in his new role, I like to call him the messenger, since he's the voice between our company and really the marketplace. And his focus should be on the counterparty and the counterparty risks and rewards. He should investigate and define those risks. His incentives should be aligned with that of the machine process. Bringing in data, maybe it leads to compensation. An example, maybe $50 per dealer questionnaire or a dealer profile analysis, or if it's worth more, maybe $500. If it's worth less, maybe $5. You know, this machine will take this qualitative data and will structure it and create a new policy and a new strategy for the dealer. It can help, you know, explain some of the things of the performance that we couldn't explain before, given the credit data or the income data or even regional attributes that we may have been using. And it doesn't mean we're done by any means. It just means he has new work to do. Once we take something qualitative and quantify it, move on. And finally, we want to be completely transparent with the dealers. You know, what did you do right? What did you do wrong? And how can we retrain you to do what we think would be better for both us as far as quality customers and you as far as receiving higher advance rates? And this creates a feedback loop in which an operational entity such as the sales team and the marketing team has now become a support function for himself. He's now gathering data, gathering information, feeding it through this machine aspect, which is then making his job even easier, and he's supporting himself. You know, they should always be searching for this data, and he's creating more efficiencies. He doesn't have to go after dealers that maybe your dealer scorecard says we shouldn't track because of data he found yesterday. Another area that I'd like to focus on here, and really kind of what would be next in the phase, is underwriting. You know, a traditional underwriter really is assessing the risk of a loan. There's really three distinct phases I think a company goes through. Whether you be in stage 3 now or stage 1, I think it's just a natural progression, with the first one being relationship-based lending. You know, this is community bankers. It's heavily based on previous experience you have with the customer. You know, the problem is without having a branch and multiple locations, it's really not a scalable model. And so I think people tend to move into phase 2 as they grow, which is the expert model. The expert model is different. It's when upper management and consultants sort of design and define cutoffs or decision rules based on previous experience of metrics and ratios. FICO minimums, FICO number of trade line hits, LTV maximums, you know, terms, when to extend the term. Does he get 36 months, 70 months, 72? You know, these are things that tend to be intelligent in nature. It's by the experience of the expert, but it's not necessarily driven by data. This is very, very useful, however, for smaller companies, especially startups, or any time a mature company, even at that, is entering a new market. Of course, you can always acquire a company and acquire that intelligence, but sometimes that's not always possible, in which case an expert model would be what you would rely heavily on. It really gets your foot in the door until your data is rich enough to automate the process. And then finally, that third phase is decision automation. Approvals are highly automated through statistically driven rules and scoring approaches. Overrides are possible if maybe an underwriter sees strength or weakness in the model, but we'll track those and we'll see how your overrides do. And this is sort of a natural phase as your data becomes richer and your automation increases and becomes more accurate. Some other functions of the underwriter, again, are the buying aspects. They're working with the dealers to restructure loans to fit a company's specific guidelines, whether it be advance rates, LTV caps, or the terms. And they're verifying the documents, working with the funders, calling the place of work, verifying insurance and address. And data is driving most of these lenders, however, towards higher levels of automation. Our approval process is very highly automated because it's highly competitive. First to the dealer may be the first one to get the loan. Dealer restructuring doesn't necessarily need an underwriter. Entities are now creating systems in which it's a one-sided operation. It's a dealer playing with a tool and designing the loan to fit the particular tier or restructure the loan until it's approved on their own. And we've also seen an increase in verifications to third-party providers. And while they may still lag in their coverage, I believe they're getting better every day just as well. So what does this mean for the underwriter? Well, just as we did the salesman, we need to reorganize the underwriter. So recall that by definition, an underwriter is one who writes their name under the risks of a transaction, thereby guaranteeing payment. From the old Lloyd's Bank of London and the insurance markets. This is no longer the case today. Today it's automation, it's the machine function. These decisions are automated. If we switch gears for a moment and just talk about credit, it's widely accepted due to its 3 C's. But what is the real root cause of defaults? People don't default because of a number that's assigned to them. Paul is a 450 doesn't mean he's going to default. The 450 doesn't make him default. He defaults for other reasons. The 450 is just a marker for performance. So why don't we have these underwriters, instead of becoming experts at these markers, have them dig deeper into finding these root causes? What is the real cause for the default on these lower scoring individuals? Is it income, education? Is it even quantitative in nature? Has it even ever been hypothesized? Really challenge them, put them to work. And this is where in comes the new and improved underwriter. We call him the analyst. He studies the not so quantitative in nature of the loan and attempts to draw conclusions and relationships to feed back to the machine. What is it that we're not looking at outside of the LTVs, PTIs, and FICO scores about the loan that gives you a good feeling or a bad feeling? You have a good gut, you claim? Well, we can test that. Give us a scale, 1 to 10. Tell us how you feel about the loan. The idea of an underwriter truly studying a loan and drawing conclusions based on the non-quantitative aspects creates a feedback loop in which we're constantly and consistently, again, fine-tuning our decisioning. We want more emphasis placed on the qualitative and less on the quantitative, just like we did the baseball scouts. This increases their time for verification. Now maybe they're verifying even more pieces of data. This gives greater depth to your data. And even doing loss reviews, looking at what maybe he got right, what maybe he got wrong. It's a necessary evil for an underwriter to look at loans he was wrong on, and it's a necessary glory for them to see where they were right and attempt to see, what they misread and where they missed it. And it forces the underwriter to get creative with the work, and this again just strengthens your feedback. And then finally, the last person I'd like to focus on here, due to the running out of time, is the collector. This is our vocal link between communications with our customers and the company. Their current functions, or they assist the customer. Customer service, account inquiries. They're the person in charge of collecting and documenting information when necessary, and of course, getting the money or promise to pay at an acceptable future date. And data and technology is really changing this. Call campaigns are really heavily based on decision rules or even scores. How often to call? What are your target penetration rates by score segment? We have text analytics. We can data mine to find correlations between the speech of the consumer and any outcomes of the loan and the customer's behavior. One thing that we currently do, which I think we can improve upon, is we instruct collectors to follow a strict call script or designated responses to common questions. Improvisation is not necessarily encouraged. And of course, we've all seen the increases in auto dialing and IVR systems and mobile and email and just reducing the human-to-human interaction. So how do we reorganize this collector? How do we make him more valuable to the machine? Well, remember, a typical collector tends to have a limited skill set. Not in all cases, but in a lot of cases, they tend to be not highly educated, or perhaps they've been a collector for a long time. And this work is very high stress, and it can lead to a very mundane attitude. So incentives are very highly motivating, as I'm sure they are in all areas, but more so here, just due to the dullish nature of the work. So let's turn our collectors into counselors. Let's listen and record the customer interaction with our analytics and our speech analytics as we did before, but let's incentivize and let's ask the collector to create conversation. Maybe use an 80-20 ratio. 80% of the time, stick to the script. We have proven relationships that have worked in the past, and we want to continue to use those. But for the other 20% of the time, use your interpersonal skills. Inquire deeper into the customer's situation. Ask about things that aren't on our script, things that maybe will eventually become quantitative and become part of our systems. If we stick to a standard call script, then it never changes, since we can't create new algorithms off of data that doesn't currently exist. And again, we want to encourage to make this qualitative data into quantitative data through the feedback loop in the machine, in which case we'll come up with new strategies and tactics. So the next slide here is just sort of an illustration here of what I call the feedback loop. It, again, starts with operations honing in on some of the qualitative data in nature. And then, of course, you have your machine, which records this data and captures it. And the data is structured and explored by your teams. And you create new strategies, new tactics, or you gain more confidence in current strategies and tactics. And then you deploy these back into production, and you repeat process, and you continue to encourage your operational groups to inquire and to gain new data and to become their own support functions. And you essentially end up with sort of an organizational structure where they're not only just in the operational realms, but they're creating their own support functions. As I said, the roles will be changing, and as things become more automated, it doesn't mean these jobs will disappear. It just means they're going to change, and it's up to us to teach them and train them and have them ready for these changes and be proactive and not to be reactive. So, without any further comments, I guess I'll take Q&A.
Hi, Preston, can you hear me?
Yes, Phil, I can.
Okay, sorry for the technical glitches. I got bounced out of the call there for a moment. So thank you very much. Going to move over to the Q&A. And you talked a lot about the balance between man and machine. And so what's the balance between automated and human decisions in a process like the loss review?
Yeah, that's a great question, and really I think it's specific to really the quality of your data and how much maybe resources you have in that particular area. I know here at Innovate, we actually have some of our analysts manually go and read through some of the scripts and some of the talk-offs that these collectors have had and determine the primary reason for why the loan went bad, and then we sort of take this reason and group it into a macro category. So if you think you may have 5 to 10 macro categories, so we're attempting to take that qualitative data and again quantify it, and then we can track, how often the first qualitative data, maybe it was income related, or the second qualitative data, maybe it was related to a marriage or a divorce or a job loss. And just track those things. But as far as automation, there are, I'm sure, companies that are far more advanced than us and in their ability to, read through these with search algorithms and not even have any human input. So I think it's very specific to the organization.
Okay. And we have a question, what are the best methods to collect data or build data warehouses?
Really you want to take a snapshot of everything that's available every day, and you want to warehouse that. You want to know, as far as best practices, you want to make sure your data is clean, obviously, but, if there's any piece of data you have on the customer, any SIF files, any balances, obviously, and delinquencies, any metrics, you want to stamp a date on them. You always want to know when they occurred, and you want to file them away, and so that even if it's not being used now, you've got your lake that you could go fishing in at a future date. There's some folks in IT at my company that are probably a little better about talking about this than me, but I know from an analyst point of view and really honing in on what data I want it all, and I tell them that, and they roll their eyes, but in reality, I may not be using it all, but it may become in handy one day. So I hope that answers the question.
Right. The questioner can follow up with more if they have more questions on that. So now we have, how important is old school judgmental underwriting in a world based on scores? Do we rely too much on scores? This is going back to the balance question.
Again, I think that the fact that the metrics and the scores are very consistent, and machines tend not to have a bad day, they didn't get in a fight with their wife that morning, is very important. But at the same time, what machines can't do is they can't find the sort of the non-quantitative parts of a loan, the gut feels of an underwriter. I find this to be extremely important. If the quantitative gets you 70% of the way there, then maybe the underwriting gets you the other 30%. And for highly automated companies, more larger, more mature companies, I hope that they also feel the same way, because what you may find is, just like we saw in the flash crash, all your scores will come together and everyone will turn down the same loans and everyone will fight for the same loans, and then someone will sneak around with this new piece of data created through their underwriting, and they'll buy those ones you turn down that they deem good. Not all of them, of course, but there's always that human aspect that I think is extremely important. And just like Kasparov and Deep Blue in their rematch, he needed the American chess player to assist him. The machine did. It's always a hand-in-hand operation.
Okay, thanks. So we're going to do one more question, Preston. What are some significant changes you've seen in light of CFPB oversight? And I think in this context, your improvisation comment about the collection calls might have made some people nervous. CFPB keeps a close eye on that, of course.
Yeah, you know, there's plenty of rules, and obviously there's you know, just as you have scripts you want to follow, you can have certain things that you tell a collector you never say, that you never do. But you don't want ever for this to prevent you from collecting data and using judgmental and trusting your collection folks to use judgmental behavior after going through thorough training on what the CFPB wants and what they deem acceptable. And you know, we're always in favor of the customer. The customer comes first. So, you know, again, 80-20, 80% you stick to the script, 20% you go off script, but don't threaten the customer. We would never encourage you to threaten them to gain qualitative data. You know, we'll tell you, and we'll watch your call, listen to your calls, and we'll let you know what's appropriate and what's not. And, you know, the regulators need to know that we're on top of that, and they need to know why it is that we're asking them to go off script. And I think maybe having that conversation with the regulators is a good way to get in front of that.
All right, great. Thank you so much, Preston. We're going to wrap it up now. The Center for Auto Finance Excellence is committed to bringing you quality content on best practices in auto lending and leasing, and we hope you'll join the center at autofinanceexcellence.org to receive our alerts and to participate in other center events. Sorry about the technical difficulties we had today, but please remember there will be a recording of this webinar on the center's website very shortly, and please be sure to keep an eye open for additional events from the Center for Auto Finance Excellence. Thank you again to our partner Fiserv for their support. Thank you again, Preston, and this concludes today's teleconference. Have a great day.